And this is case study number 3 in Finance 611 for the summer 2020 session at Walsh. We're looking forward to sitting down with you, Sandy, stock picker, and discuss your many investment options that myself and my coworkers have gone through. My name's Aaron Wood, and my coworkers that you'll be hearing from are Joseph Myers, Wyatt Parkhurst, and Carl Rivera. Without any further ado, next slide. So obviously, when we're talking about investments, there are different levels of risk and return. If you could get all of your return or 10 times your return, obviously there's going to be more risk involved versus getting a fraction of that. And that's just due to the essence of investing. If you look at the chart to the left, it's the simplest of charts, but you can look and you can see the lower your risk, the lower your return. You can also see the higher your risk, the potential higher of your return, but once again, the higher also chances of loss. With investments, there's always going to be a relationship between how risky your investment is and versus the desired returns of the investment. And that's why we've sat down and put a lot of thought into the different options that you have to try and see what would suit you best in terms of your desire for risk versus reward or return in this case. For instance, if you didn't want any risk whatsoever, we could go with one of the safest investments, which is U.S. Treasury bills, which return 3% right now. Many investments, though, have been safe and proven over time and can provide a lot more return than that. But that is one thing to kind of talk about the safest investment you can make. Next slide. So one of the things that we'll be talking about during this presentation that we wanted to be sure you understood on the front end was beta and standard deviation. So standard deviation, it is a measure of the variability whereby the bigger the number, the more deviation or values within each segment. So for instance, if a stock, the most it could go up, let's just say it returns 2%, and the most it could go, if the stock market hits on all cylinders, is 4%, or the lowest it could go is just even, you have a variability of 4 within the bell curve, which is the different standard deviations. And you know the bell curve is in the middle where it returns to 2%, and then it's just as likely to go a little bit above and that chunk right above to 3% or below just above 1%. Beta, while it talks a lot about the variability in return, it actually has more to do with overall the market, what's happening there, and how your investment tracks with that. So a stock having a volatility in relation to the overall stock market with a beta of 1.0 is your stock is actually moving in lockstep with the market. So if the market goes up 10%, you go up 10%. If the market goes down 10%, you go down 10%. If the beta is less than 1.0, it's considered low beta. An example of this would be a bond. Those tend to be smaller because in beta because they tend not to move with the stock market versus high beta stocks are considered riskier, but you could get a higher return. So think of ones I'm sure you heard of in the news, Tesla or Amazon. Stocks like that, while they can grow very quickly overnight, they could go down very quickly as well. U.S. Treasury bills are kind of unique. They don't have a beta, and they also don't have a standard deviation. Why? That's a great question. Well, the reason is they don't have a beta because they are not volatile at all. What you buy it for on day one, at that set time frame that you plan on turning it back in or getting your money back on, it's going to return that exact dollar. So it doesn't matter what the stock market's doing. You know what you're getting at whatever set period of time down the line. It also doesn't have a standard deviation because the investment doesn't go up or down in value. In this case right now, it's giving a return of 3%, and it will be 3%. It's not going to be 2% or 4% or anything else. So it's something that you can count on. But once again, there is that balance between risk and reward, which my counterparts will be talking about. Next slide. So speaking of that, we've done a deep dive analysis on 7 different portfolios next, and then we're going to go into a couple other investment options later with the S&P 500 and the NERV, which is an international fund. And we want to have the opportunity for you to see what might be best with your portfolio between risk and reward or return. Next slide.
Hi, Sandy. So we're going to look at putting your money to work here. We're going to look at different portfolios, like Aaron said, allocating different amounts of funds to different stocks or assets. First portfolio we're going to look at is investing 100% of your money into the Acme company and their stocks. So expected return of Acme company is going to be 6%. Standard deviation, or the volatility, is going to be 0.3529. And if you're investing 100% of your funds in that stock, then your portfolio expected return is going to be 0.06 or 6%. And your risk, volatility, standard deviation of that portfolio is going to be the same standard deviation as the company itself, so 0.3529. We go down and look at portfolio 2. We're investing 100% of our funds, your funds, into Smith Corp. The expected return there is going to be 8.5%, and your beta.
Your beta is 1.05, which is just a little bit out of lockstep with the market. As you can see, this is one of the ways that we could invest your money. Looking further at portfolio 3 with Jones Incorporated, you have an expected return of 12% with a beta of 1.8. This is, once again, what I referred to earlier is like the Amazon of stocks, and that it's not following lockstep with the market, but it also has a higher potential for expected return. As you look through this with a weight of 100%, you can look at how we balance all the numbers. The last one, just to kind of give you a more control, if you will, is portfolio number 4 with the U.S. Treasury bill. As I mentioned earlier, it has an expected return of 3%. There isn't any beta because it doesn't move with stock market. It moves on its own beat. There isn't a standard deviation as the others have, as you can see above, because at the end of the day, it's going to return that 3%, and that's something you can count on. Next slide.
Thanks, Aaron. Now we're looking at portfolio 5. So portfolio 5, we're going to look at an equal allocation of your money to each of the 4 assets. So we're going to have 25% of your funds in Acme Company, 25% in Smith Corp, 25% in Jones Inc., and 25% in the risk-free asset U.S. Treasury bill. Diversification, it helps significantly decrease that systematic risk and the volatility of your portfolio. So that portfolio now is going to have a risk of 0.1209, 12%, and your expected return is going to be 7.38%. Next slide, please. So now portfolio 6, we'll look at allocating 100% of your funds distributed evenly through the 3 stock options and not the risk-free asset. So 33% in Acme, Smith Group, and Jones. Your expected return there is going to be 8.83%, and the portfolio is going to have a standard deviation of 0.1612. If you look at the other standard deviations of the individual assets, Acme Company, 0.3529, 0.2857 for Smith Group, Jones, 0.1667. So if you look at the standard deviation of the portfolio, that diversification brings down that risk. Next slide, please. Now we'll invest half of your funds in Smith Corp and half in the risk-free asset, and that's portfolio 7. So we have Smith Corp putting 50% of your funds in there. Your expected return total is going to be 5.75%. And your standard deviation or volatility of the portfolio is that 0.1428 you see at the bottom. Next slide, please.
Now for our recommendation, Sandy, we would have to recommend portfolio number 5. The way we've come to this conclusion is through the use of the Trainer's ratio. What this ratio does is it takes the expected return of the entire portfolio and subtracts the risk-free rate of the market, which in this case we receive from the U.S. Treasury bills. And it divides that result by the beta, which is the risk. What this shows is that for every point of risk, it shows you how much return this portfolio is going to gain for that increase in risk, and vice versa. On an interesting side note, portfolio 4, which is entirely consists of the risk-free treasury bond, does not have a trainer's ratio. Next slide, please.
So Sandy, there are some other things that we need to consider when we build your portfolio. So with the portfolios that we've already shown you, we've only shown you 3 companies and exposure to the risk-free treasury. So it's important that we know that as investors, there's 3 different types of investments that we all have access to. We have stocks, bonds, and commodities. And the reason why that's important is that those will help provide diversification depending on what business cycle and economic cycle we're in. So as we know, stocks tend to do well in growth environments. Bonds tend to outperform in recessionary environments. And commodities, so agriculture, precious metals, oil, for example, tends to actually outperform in periods of high inflation. So as we go through the highs and lows of the market, it's important that we diversify and have exposure, because we can expect one asset class will outperform the other, depending on the business cycle or the economic cycle we're in. So that leads us to our next point when talking about indexes. So the S&P 500, which is 505 stocks located in the United States. And the way that is weighted is by market capitalization. So if we take the shares outstanding and multiply it by the stock price, we get the weightings of the S&P 500, which again is 505 of the biggest stocks located in the United States. And the Nirvana 500 is weighted the same way, except we look at international companies. And the reason why that's important, unlike the portfolios we've already shown you, is that these indexes already have some degree of diversification. So when we look at the S&P 500, the fact that there's 500 companies, we know that all those companies aren't in the same sector. And, you know, for example, if we take COVID-19, technology companies have performed significantly better than energy stocks or travel companies. So when we try to increase expected returns while lowering risk, using index strategies, like building a portfolio of just those 2 different index can help increase returns over time and smooth out the volatility that you will receive when getting those returns. What's also important too, Sandy, is there's a couple of things that we have to consider about you. There's been a lot of emphasis in the investment industry for a long time about being return focused, but we don't think there's been enough emphasis on measuring your risk tolerance. Behavioral finance would tell you that you feel the pain of losing money a lot more than you enjoy the gains of making money in the stock market. So it's important when we build this portfolio, we cater this to the amount of risk that you are willing to take on. Next is your time horizon. So the stock market, for example, is very risky in the 1-year period. It's risky if you need the money in a 5-year period. But over a 10, 20, 30-year period, the stock market has historically done incredibly well for investors when the time horizon is expanded. So if you said to us, hey, I think I might need a certain portion of my money in 2 years, well, then we would seriously consider putting some money into safer assets like risk-free treasuries, corporate bonds, things that experience less volatility than stocks. And then the next thing we need to know is the tax status and where these dollars in the portfolio will be held. So qualified retirement assets. So think of a 401k, an IRA, and then a Roth IRA, for example. Those you do not pay capital gains taxes on annually, and you don't have to pay taxes on any of the interest income or dividends that you receive. And the reason why that's important is, let's say that you are in a high tax bracket. Well, in a taxable account, we would want to build the portfolio so that we don't create a drag on performance by owning high yielding dividend stocks or you're receiving a lot of interest income. That portion of the portfolio would likely be held in a qualified retirement account. It's also very important that we understand that the tax drag a person may receive does hinder someone's returns over time. So it's important that we remain as tax efficient as possible when we build your portfolio, considering both your time horizon and your risk tolerance. Next slide. So we've all heard the saying, let's not put all of our eggs in one basket. So as I mentioned about risk tolerance, there's also risks that a portfolio can have. One of them we can eliminate fairly easily. The other one is much harder to do and can be expensive. So the first risk that we have is unsystematic risk. So that would be putting all of our eggs into the Acme stock company. And the reason why that may be a bad idea is if that company has a bad quarter or something happens to the CEO, well, then all your dollars were probably adversely affected by just one company having poor earnings or a tumultuous corporate time. On the other hand, systematic risk is market risk. So think of the S&P 500. If the market doesn't do well, then your portfolio probably isn't doing very well either. That can be eliminated through the use of derivatives. So if we buy something called put options, which can be expensive, and that's something that we have to talk about if you did need that level of portfolio insurance. And like I mentioned before, stocks, bonds, and commodities all tend to out and underperform depending on what the economic or business cycle is. So we would want exposure to all three, knowing that when one outperforms, the other are underperforming. We want to rebalance and make sure that that's in line with the unit of amount of risk that you would want to take on. And let's take a second to look at that chart that is provided. And what we can see is if we were going to build a stock portfolio, risk begins to get significantly reduced without hurting the expected return at around 20 stocks. But the benefit of diversification begins to level out at around 40 stocks. So if you want us to build your own stock portfolio, we would look to build a portfolio ranging between 20 and 40 stocks versus if we hold just one security that opens us up to a wide range of outcomes. And to be honest, potentially bad outcomes because we're not diversified. Next slide.
On a final note, we know that you have some apprehension in investing in foreign markets. So here we've constructed 11 portfolios, which are varying weights between the S&P 500 and the NERV from Nirvana. Both of these indexes have an expected rate of return of 10%. So no matter what the weight is, either way, it will not affect the return of the overall portfolio. However, both of these indexes do have different betas and standard deviations. So from this list, we would recommend portfolio number 3. This is because that the weight between the two leads to the lowest standard deviation, meaning that you always get your 10% expected return, but the portfolio is not expected to vary nearly as much as the others.
So Sandy, at the end of the day, there's a lot of investment opportunities for you that we've all talked about, and it's really up to you to decide where you want to, how much risk versus how much return you're expecting. And that's something that we'd be happy to discuss further as we talk more about what specifically we can tailor towards you. Thank you.